Okay, so we are talking about, there are two methods through which we can value any company. The first is called the DCF method, okay, which I mean, knew about, a little bit. Uh, this is basically, I'm just writing on the top, valuation of an asset or a company We can, whatever, the value of an asset means the value of a company itself. Okay. So first method is called the DCF, which is called the discounted cash flow. Okay. And or we can say intrinsic value. So whenever we calculate the value of a company using, here come. So the first method is called the DCF method, or it is called the intrinsic valuation method, which is basically a scientific method. Okay, intrinsic means the real value. What should be its fair value? Okay. Now, the value which we calculate using this method may differ. If it's a listed company, then the stock price is already there in the market. Okay, and we are just calculating another stock price using the DCF method. Now, we may find that the stock price calculated through this method may be different than what is prevailing in the market. So, if the DCF method is showing a higher valuation, that means today the value in the market is lower. Okay, so it is undervalued. Fine. Or if this method gives you a very low valuation, okay, and whereas the stock price is prevailing at a much higher value, then we say that the stock price is overvalued. Okay. So in that case, a company can decide, whether they should want to acquire that company or not. Okay, or can they negotiate with the company? Because the markets can always make mistakes. It's always believed that markets either overvalue or undervalue the stocks. Fine. So that's why the market keep rising at times, because of a lot of optimism, or sometimes there is a pessimism when everybody is selling, like not happening now. So the valuations are brought down. So the stock prices which are prevailing in the market are not reflecting the true value at which it should be, trading. So DCM method is basically a very scientific method which gives you an idea what should be the real value of a stock. So there is another method which is called the relative method, or we can say comparable asset pricing method. Comparable asset pricing method. I can just put it like this. Okay. So, which is not basically a valuation technique, but it tells you, it takes into the stock prices which are prevailing. Okay. So it is basically, it values the asset on the basis of what it is, how it is valued in the market. And market can make mistakes, as we know. Okay. But this is a very easy method. Okay. And we can always, use this method to value a company. And we can use both the methods at the same time and find out, the value as per both the methods also. Okay. Now, to give an example, very simple example. If suppose you are looking, for example, we take an example from the real estate. Suppose you are looking for a house. Okay. And you go to, you're looking for, say, a 2-bedroom or a 3-bedroom house, for example. Suppose you're looking for a 2-bedroom or a 3-bedroom house. Suppose you're looking for a 3-bedroom house, a high-rise in a high-rise building. Okay. And what do? You go to a real estate consultant or a broker, and he will show you many houses, isn't it? In that locality where you want to, purchase the house. Suppose you are looking for in Sector 15, Gurgaon. Okay. For example, we have to take example where, we are looking, we are, my office is very near to that place, or if I am married, then my children are also going to school, so there should not be any, discomfort to them. So I buy a house where I find it is more suitable for me, depending upon many conditions. So then, I asked my broker that I want to look at a house in, say, Sector 50 or Sector 49 or Sector 48, because from there, all places of my office as well as, other things, markets are very nearby. So he'll take you to, he will, first he'll say, okay, we have, find out some houses which are available for sale. So you will, go along with him. Okay, please listen it carefully. Okay? The focus here is very important. Otherwise, you will miss out the purpose of this valuation technique. So he'll take you to basically and show you many houses there. Okay. So you saw a house which was, you saw 2 bedroom, 3 bedroom, 4 bedroom. So he showed you all, and then he says. Then you ask him, you like one of the house, okay? And you say, what is the price of this house? Fine. So you say, what is the market price of this house? Of flat, I can put. So he says, it is 3 CR. This is a 3 bedroom house, a 3 CR house. Okay. So I just put a figure here. Put some commas to understand whether I put it right. So how much is coming to? It's coming to 3 CR? Unit 10, 100,000, 10,000. Yeah, it's I think 3 CR, is it? Is the right number? Okay. So market value of this thing. And then, it was a 3 bedroom house. Okay, a 3 bedroom. And the area is about, say, 3,000 square feet. Okay, this is the area. Fine. So then this is basically a 3 bedroom house, and okay, fine. So you just try to know that what is the price per square feet. So it comes to about 10,000. So then ask some other houses, and you find that the prices in that area are around close to about 10,000 square feet, 9,500, 9,800, 10,000, because the area will have the similar rates pattern. Okay, if you are looking for a villa or a building, then it will be per square yard the plot rate. Okay, which is currently at 2,40,000 in sector 50. So you will get the same thing there also. Fine. So you took the market value and divided by the square feet. Okay. Okay. Now, if you happen to like a house which is which is say 2,500 square feet. So you saw another house because you thought 3 crore is very high. Your budget is little lower. So you saw another house which was 2,500 square feet. What should be the price of that house? What should I do? I ask you this question. If he showed you a house which is 2,500 square feet, okay, which is in the same area. So what should be the value of that house? We will simply multiply this with this. So you'll find that the house is 2.5 crores. So this is called the relative valuation. So what are the steps? First, you look at when we come to say companies, we look for similar companies, which are similar, maybe in similar size, okay, or they belong to the same industry. Fine, like IT companies, all Wipro, TCS, HCL, Infosys. So all are IT companies, isn't it? Fine. So similarly, as we are looking at a house in say, sector 50 or thereabout, so here we can say that these companies will also be trading at a similar value, isn't it? Okay. So how do we do that? Basically, here what we do is we look at two things. One is the market cap. You know what is market cap? Total value of the company. Okay, the total market cap means that if you want to buy all the shares of the company, you have to pay that much of price to acquire that company, based on the price prevailing in the stock market. So market cap is basically determined on the price which is prevailing in the market. Suppose a company has 1,000 shares and the share price is 2,500. So what will be the market cap of this company? Suppose this is number of shares. and this is basically the share price, and this will be the market cap then. So market cap of this company is how much? 25 lakhs. Is that okay? Fine. So like market price of the flat. So we have determined the market cap. Similar market value of the company. Okay. Then we look like, we have standardized the price here. We took the area, divide the value by the area. We got some, metrics, which is called, 10,000 rupees per square feet, and then multiplied with the house which we are looking for, which is of a lower area or a higher area, we can calculate the value of the company. Now, this will be only applicable for a similar locality because the rates keep changing. Now, suppose in Gurgaon, Sector 50, the rate is 10,000. Then in Delhi, in South Delhi, the rate is around 25,000. If you go to Kolaba, it's about 75,000 rupees per square feet. It will keep changing depending upon the locality. Fine. So it is comparable asset pricing method. We just compare the assets which can be compared. Okay. So we look at the area here, square feet. What we'll do is we can look at, we can create a multiple, like we created in the case of house. We can also create a multiple. Multiple was the market value divided by the per square feet or the square feet. It's called the multiple. You're creating a multiple and then multiplying the multiple with the area or the house which you're looking for, and then you calculate the value of the house, isn't it? So what here we look at? We look at the profit of the company. How much profit a company is making. Now, higher the profit, higher would be the value of the company, isn't it? Lower the profit, lower the profitable company, lower will be the value of the company. So profit can be, considered for calculating a multiple. Now, what is basically profit? Now, suppose we take the same example here, okay, and number of shares, and then we take this basically, the profit of the company. Suppose the profit of the company is say 50,000. Okay. Suppose the company made a profit of 50,000. So what we'll do is we will divide this profit by number of shares, 50 rupees. So this is called the earning per share, EPS. That means how much a company is earning per share. If the company makes a profit of 50,000 rupees, okay, I just put a comma here also. No, chalo, koi zarurat nahi. So company's earning per share is how much? 50 bucks. Okay. Now I can even increase that and make it to say 3,50,000 or whatever. So EPS is 350, isn't it? Now what I do is I take a division of this. Rather, what I'll do, I'll take basically what I'll do is here I'll just, this is the share price. So this is, I'll just put one more column here. And this is number of shares as usual. This is the profit. Okay. This is the profit. So what I do is that I just shift this here. Okay. Fine. So market cap and profit. Fine. I'm comparing that. So what I do is, and then I can even calculate the share price, which is nothing but 2,500. Okay. I can just put like this. Okay. And this is again the share price. Fine. Is that okay? I'm just repeating. So number of shares are 1,000. Share price is 2,500. Market cap is 25 lakhs. Okay. Total profit the company is making on 1,000 shares is 3,50,000. Okay. So I can convert the, I'm back into share price by market cap divided by 1,000, which is nothing but 2,500, which I've written here. This is the share price, and this is the earning per share, which is, taking profit and divided by number of shares. Okay. So what I do is, I just make a division here. Market cap divided by profit. How much come to? 7.14. Okay. Suppose I make it a little bit more, number. It's 10. So 10 is quite a round number. Okay. And I can even calculate this like this also here, same. This divided by this. Both are coming 10. Okay. And this is called a ratio or a matrix. Like in case of first we calculated a house. So this is called PE ratio. Very important ratio. PE ratio, price earning ratio. Okay. So that means this stock is today trading at a P multiple of 10. We can say that. Okay. Without looking at any number, we know the numbers, but we can say that this stock is trading at a P multiple of how much? 10. Fine. Now, suppose this is in one industry. Suppose there is another company whose, which is not listed in the stock exchange. Okay. But its earning per share, we know, because we know how much profit it is making. Suppose it is making 50 rupees or 50 rupees of earning per share. Okay. So this is EPS again. So company is earning 50 rupees per share, another company. So we want to value that company based on the company which we have just seen. Like the first house we saw, we calculated a multiple. So we found that companies in this industry trade at P multiple of 10. So now we want to know that what price this company should be trading at. What should be the real price of this company? Mohit? Anyone? Dhruv?
We don't know the number of shares.
We don't know the number of shares, but we know, we know the PE ratio. Okay, PE ratio is what? PE ratio is nothing but the price divided by EPS. Okay, fine. So here we have the PE ratio, we have the EPS, but we don't have the price. So one number is missing. So we can calculate that. It's a formula now, isn't it? We know that the PE ratio of a similar company in the similar industry, trades at P multiple of 10. Yeah. 500. So very simple. Yeah. Good. So we can just say that the share price of this company should be 50 into 10. 500. Isn't it? So based on this matrix, based on this method, which is called the comparable asset pricing model, we can make a multiple. Okay, this is one sort of multiple. There are many other multiples also which are being used, okay, to calculate the value of the company. This is the most popular multiple which is being used world over for valuing the company. Okay, yeah.
So, thinking about when we were discussing about the market price decline, so there when we were taking out the PE ratio divided market cap by profit.
Yeah, so that is one way. The second way was we could have taken the share price divided by the earning per share. We would have the same P multiple of 10, isn't it? एक ही चीज है ना? The common factor is share price. So market price is what? The market price the share into the number of shares the market cap. Okay, so the share price cancels out. So we get, the EPS, whatever, I mean, something gets out, so we get the same number, isn't it? Okay, find it. So number of shares cancels out. Fine. So number of shares is the common this thing, so that goes off. So we can calculate the PE ratio. Is that okay? Is it okay? Now the PE ratio is a very, very important metrics. So I'm not going to add some more multiples to make it a little bit confusing. So let it remain as a P multiple as the basis of valuing companies, which most of the companies in the world use this method. Okay. Now, when we look at the P multiple, if the P multiple, if we look at the average P multiple of all the Indian companies today, is close to about 18. If you look all the 10,000 companies which are listed in India, go to the stock exchange and check what is the P multiple, average P multiple of all the companies in India, it is trading at a multiple of 18. Isn't it? And if you look at the historical average, they range around between 17, 18. Suppose over the last so many years, on an average, Indian stock market trades at a P multiple. That means all the companies in India, okay, if we just use the same mechanism, okay, and calculate the weighted average multiple of P ratio of all the Indian companies, it comes to about 18, okay. And if we say that on an average, India trades at a P multiple of 18, so we say that the stock markets are, fairly valuing all the companies. But at times, the P multiples keep changing. Okay, about a month and a half back, when the markets were rising, okay, before the Ukraine war happened, the P ratio was close to about 20. Okay, fine. Whereas the average P ratio should have been 18. So we were overvalued in that sense. Okay. The lowest P multiple which happened in the financial crisis, which hit the Indian market, was 9. Below that, the Indian markets have never traded. So it touched 9. It was all-time low compared to what happened, say, maybe in 1930s, when the market existed at the time, when there was a great recession. Okay, that time the world markets were trading around a P multiple of 7 or 8, okay, or 9. So we touched that level and then we remount from there. Okay, this is just a perspective from the market, this thing, valuing the whole of the stock exchange. But here, interested in marketing, valuing a company. Okay, so when we value a company, we don't look at the total all India valuation, we look at the industry valuation. Okay, suppose we are looking, say, IT industry. So at what multiples they are trading. So let's go back to the screen up and see that. So open your अगर सारे खोलेंगे तो शायद नहीं, खोल लो, आप खोलो, क्योंकि I think in the last class what happened was that there were 180 students, so that's why it collapsed. So I don't think it will collapse here. So let's say Infosys. Let's go see, all the companies, and I think we should log in. So it is always better, you will get many things here. Have you created an account here? तो बाद में account create कर लेना आप. It's a free site. Huh? You have created, okay. So it will help you out basically, okay. I'll tell you how it will help. So as I open, so you'll find a lot of, it has got so many things. So I can add ratio table. So I can keep adding what I need, okay. So it will get populated. So what is the stock PE here? 33.2. What is the industry PV? Let's say go to the industry PE. Are you getting somewhere industry PE? Where it is?
So it's 2 rows below stock P.
No, it is industry PBV ratio, not PE ratio. Somewhere we are getting, I think I might have included there. Peg ratio, book value.
So it is a row below peg ratio.
Below peg ratio. Price to book value it is.
Below that.
Industry P. So industry P is around 34.6. So that means all the companies in an IT pack, they trade around an average of 34, whereas Infosys is trading at 33.2. Is Infosys cheap or costlier compared to the industry? The lower the ratio, lower the value. Higher the P ratio, higher the value. So that means Infosys is trading a little bit below its fair value. So if you have to make a decision to buy it, you can buy it. But this is one such indicator. So we should not always rely only on one indicator. But this indicator is saying at least the stock is not overvalued. Is that okay? So now if you want to see what are the other players in this industry, so go to the peers, okay? So who are the other players? TCS, Infosys, Wipro, HCL, all these are the players, okay? Look at the P ratio of all the companies. So which is the cheapest company in India? So they have to be cheaper compared to its peer. But sometimes this figure can be misleading. Okay, I'll tell you later. I'll just come back to that. So that means, what are the rules, first of all? If the P ratio is very high, it can be either an overvalued stock, or it is that the future of the company is very good. Company is going to, company is growing at a very fast pace. So people are buying it. it is making the P ratio higher. Okay, but they know the next year the company profit is going to double, maybe. Okay, or maybe go by 50%. So what will happen? The P ratio will become half, isn't it? After all, P ratio is what? The denominator is the earning per share. If the earning per share doubles, then the P ratio become half. So this is the current P ratio. Okay, this is the P ratio which is prevailing now. Okay, if we take I take the earning per share the next year and divide the same to the market price per share, the P ratio may look to be quite reasonable, isn't it? Okay, so either the company is overvalued if the earning per share is not growing in future, but if the earning per share is growing, then the share price is not overpriced, isn't it? So there can be two versions of the higher P ratio. Okay, now look at the lower P ratio. The lower P ratio would be the ratio that the company is very cheap. We should go and buy. Company is doing very well. And in many cases, those companies are small companies which are growing at a much faster pace, but all the investors don't invest in that company because it's still not known to the public. Public has, the analysts have not, gone into the analysis of that company, and they are commanding a low P multiple at the moment, but their future looks to be very good. So if they're trading at a P ratio which is less compared to the industry, we should go and buy them. Okay. The second can be that the company, is trading at a low P ratio because, it's rightly valued because the company is not growing at all. So people are not buying it. Okay. So the P ratio is what it should have. Okay. Fine. It's the right P ratio. It's not, undervalued, but it commands that P ratio. Okay. So if we look at the industry P ratio and we find that it is lower, so which means that it is not growing as compared to the industry. That's why it is low. Okay, fine. So there are double meaning for both the things: higher P ratio as well as lower P ratio. Okay. Now, then how do we find out? How do we, make a decision whether the company is really good or bad, or whether it is, not very highly valued? So in that case, we look at the PEG ratio, which is a new version of the P ratio, which is the extended version of the P ratio, which takes care of everything. This is, considered to be the best ratio to look at. But it comes with some riders. G here stands for growth. At what rate it's going to grow. So the formula for the P ratio, PEG ratio would be like this. Let's go back to our Excel sheet. Okay. So this company is trading at a P ratio of 10. Suppose let's go here. So I'll just run the scan because it is not, I'm not able to catch the cursor. Okay. So let's take, one company X. And say the market price per share. I'm writing MPS or share price, okay? share price is say 200 and EPS is say 30. So what should be the PE ratio? So PE ratio is 40 here. So this is EPS and this is the share price. Okay, so this company is commanding a PE ratio of 40, right? Okay. Now, if the growth expected, growth in earning per share, when we say G, okay, so the PE ratio will be, the PEG ratio here would mean the PE ratio divided by G, okay. So the formula is PE ratio divided by G. If you want to calculate the PEG ratio, so the growth is say uh, say 30%. Next year, the earning per share will grow by 30%. Okay. So we just remove the percentage, it is 30%. Okay. So I put it 30 again here. And then calculate the PEG ratio. 40 divided by 30. Okay. So this is the PEG ratio.
Well, can you repeat again?
I'm just repeating again. So actually, I was not able to manage the cursor because of some virus there. So I'll just repeat that. Okay. So don't worry. So fine. Suppose the share price is 200. Okay. And company is earning 5 rupees per share. Fine. So what should be the PE ratio? 40, which is your share price divided by earning per share. Okay. But the company earning per share next year is going to grow by 30%. Now you must know what is going to be the growth in the next year. Now we can always find out that. I'll show you from where you can get that. So the growth is going to be 30%. So what we do is we calculate the PEG ratio. It comes to 1.3. Suppose the growth was say 20. Then the PEG ratio was 2. Is it? When the growth is say 40, the PEG ratio is what? 1. If the growth is going to be 60, then the PEG ratio is, sorry. Okay. So if the growth is going to be, 60, the PEG ratio is going to be 0.6. Isn't it? So higher the growth leads to the PEG ratio to fall. The lower the growth, the PEG ratio will go up. Now, the PEG ratio 1 is considered to be a very safe PEG ratio. Okay. The company, if the company is trading at a premium at its growth, then we say that the PEG ratio is more than 1. If the share price is trading at a discount to its growth, then we say the company is trading at a then here what is happening is that the PE ratio is 30%, okay, or rather 60%, then the PEG ratio was 0.6, isn't it? Okay, so it is trading at a premium to its growth, discount to its growth. Okay, the growth is going to be 60%. So just forget this. This is not the growth now. Growth is 60%. Okay, so the PEG ratio will be point. The company is going to grow at 60%. Okay, if the company was supposed to grow at only say 40%, then the PEG ratio is 1. Okay, or we just take one example. It is going to be 30%. So then the PEG ratio goes higher. So that means the price is trading at a premium to its growth. If the PEG ratio is more than 1, fine, because the growth is only 30%, okay, and the P ratio is 40, so we'll get a more than 1, okay. So the general rule is that the PEG ratio 1 considers to be that the company is growing at par with its growth rate, okay, fine. But if it is more than 1, the company is trading at a premium to its growth rate. If the PEG ratio is below 1, we say that the company is trading at discount to its growth rate. So which is better? Discount, premium, or at par? Which is a better scenario? Which is a better scenario? The company is growing at a premium to its growth rate. The company is trading at a discount to its growth rate. So which is better? Discount or premium? Mega? Just, huh? No. Growth. That means if the company is trading at a premium, that means company is overvalued. Okay. And if it is trading at a discount to its growth rate, that means companies today valued cheap. The company is growing at a much faster rate, but the ratio is low. Okay. The P ratio 1 is considered to be a very ideal ratio. Okay. The most ideal ratio should be 1. That the companies, keep like, for example, if the P ratio is today 40, okay, fine. If it is growing at 40%, then we'll have a PEG ratio of 1, which means it is not very costly. Though the P ratio may be very high, but it is not, costly, because the next year we'll have the growth will take care of this high P ratio. Okay, fine. Isn't it? So because what happens is that suppose अभी तक ठीक नहीं हुआ ये. Suppose what I do is I just multiply this uh, into 1.4. Okay, so I have taken a 40% increase here. Okay, and then I calculate the P ratio again. So my P ratio falls to 28, isn't it? 29. Suppose the earning per share is going to grow in next year, say by 40%. Here I've taken 40%. So that means my P ratio, next year P ratio should be 29. But if I take it like this as 0.3, then the PEG ratio is 31, P ratio is 31, isn't it? And then 29. Okay. Suppose I say that my company is going to grow at say only 10%. So the P ratio will be only 36. Higher the P ratio, higher the valuation. Costly is the share. But if I take the growth as 30%, next year the EPS is going to grow at, say, for example, it is going to grow at, say, 40%. Okay. So the PEG ratio is 2029, which looks to me much better. Lower PEG ratio means lower valuation of the company. Higher the P ratio means more value the company is having. A lower the P ratio. So what we do is basically we try to see at what rate the company is going to grow in future. If the company is going to grow at a very high rate, then the P ratio will automatically fall, isn't it? So instead of calculating the current P ratio, we look at 1 year forward P ratio and then try to find out how the company looks like. Is it still costlier? Okay. Or is it cheaper? Have you got it? Okay. So a PEG ratio less than 1 is considered to be the company is undervalued. A PEG ratio more than 1 is considered to be a company is overvalued. A PEG ratio of 1, it's fairly valued. So that is a general understanding. But if you go back to the screener and find out your company, which we saw earlier, was trading at a 4 point. Okay. So here, what is the PEG ratio of this company? Infosys. But though it is cheaper compared to the industry, because it is commanding a lower P ratio compared to the industry, but the P ratio looks to be quite high, 4.47, isn't it? But then why people are buying? But because it is almost like 4 times more costly than the PEG ratio itself. Okay, fine. But in that case, again, we should take the industry PEG ratio and then compare. You want to get the answer. Look at the industry PEG ratio. And that, because I say the markets can always make mistakes. Markets can be either overvalued, industry can be overvalued in totality. So if the entire industry is overvalued, then what is the PEG ratio of the industry? And then we compare the pay ratio versus the pay ratio of the Infosys. Fine. So here, are we getting the pay ratio of the industry? No, it is not there. Fine. So we'll have a look there later on. So, so there are two methods through which we value the company. The first method is called what? क्या नाम है आपका? Ashutosh, what is the first method? How do we value a company? What are the various methods through which we value a company? There are two methods which we studied. Okay, what? And comparable asset pricing. So there are two methods. One is called the Dcf method, discounted cash flow method. It is also called the intrinsic value. It calibrates the real value of the company. It's a little complicated because it requires a lot of calculations, more scientific, okay, and sometimes you can make mistakes because it goes into the future. You know, find out how much cash flow the company is going to make, then we will discount. First of all, we should have an assumption how the company is going to do in future. So we either interview the management, okay, the CFO and the CEO, and try to find out what is the future of the company, at what rate it is going to grow, or we look at the market trends, okay, or we look at what product the company is manufacturing and what is going to be the market demand in the next few years, okay. So then we try to project how much cash the company is going to generate. So it requires a whole lot of assumptions. Then what is the present market share of the company? Is it going to grow its market share or the market share going to be steady? So if it's going to grow, then the cash flows are also going to suppose the company today is having a market share of say 10%. And in the next 2 years they want to double their market share. Okay? So their market share will also go up and their cash flows will also go up. Fine. So there are a lot of assumptions which you have to make in terms of what is going to be the growth potential of the company and how is going to be the market demand. What are the people who are going to buy the products? Is the market growing itself? Is the market means if as the population is growing and the people are becoming more affluent, their per capita income goes up. So they try to buy those products. Okay. Previously there were no money. Like for example, a car. The growth of cars has to steadily increase because there are more and more people now can buy a car compared to what they were supposed to buy. But if you look at the share of marketing, which was at one time was 80%, today it's only say 20 to 30% of the market share. Okay. So there are a lot of parameters of which we work out how much money the company is going to generate in future. Okay. And ultimately we have to find out how much cash flow the company is going to generate every year. And then we are going to use that company, we are going to discount those cash flows using the appropriate discount rate or the cost of capital. That risk in the company, at higher cost, they're going to get money from the public. Okay, so the discounting rate will become higher, will lower the valuation. Okay, now if I just say that company like BLF or company like say or Infosys, which will be valued more well by the shareholders, which will command a more P ratio. For example, let's say if you have to find an answer, the companies which are having a higher P ratio, that means people are thinking that the companies are going to grow much faster. The companies which are having a lower P ratio, people think they're not going to grow very fast. So if you have to compare that, so all the new companies, new economic companies, they always command a higher P ratio compared to the old traditional manufacturing companies. Fine. So at one time, Tata Steel was trading at P multiple only 8 or 9. Today it's trading because there's a lot of demand which has been generated. Okay. Whereas Infosys, trades at a P multiple of say 30. So look at a company like a Tata Steel and see at what P multiple Infosys trading 33. Let's say Tata Steel or Tata Motors or Tata Steel. Let's say Tata Steel. So what is the P ratio of this company? 4.27. So it trades a very low P multiple. It is way back in 1992 where Tata Steel was considered to be a very good stock, and everybody recommended to buy Tata Steel. It was considered to be like owning a Mercedes. So either you only having a Tata Steel in your portfolio, having a Mercedes, it was called the black gold in those days. So going by that, this thing I bought Tata Steel at 600 rupees. Okay. And till, last year, the stock price was trading at 600. So from 1992 till 2021, the share price hasn't moved at all. Okay. Only in the last 1 year, you find the share price going up. It has gone to 1300, doubled in the last 1 year. Okay. It has its own reasons, but the stock has been very because buying price. It's trading at a P multiple of very low of 4.27. Whereas it is trading at a P multiple of 33. Okay. So all the companies they look at it will, or Hindustan Unilever, which is basically selling products which everybody consumes. So should it have a higher P ratio or low P ratio? By intuition, higher P ratio. So let's look at Hindustan Unilever. It will have a staggering P ratio of 54. It will have an P ratio. What is that P ratio? Can you see that P ratio of the okay. So all the industries within Hindustan Unilever, they trade all at a very high lofted P multiples. Look at the peer ratio. The peers, Hindustan Unilever, Procter Gamble, Colgate, Gillette. So these are all basically companies which are okay. FMCG companies always demand a higher P ratio. So they are always doing. So all these companies have a valuation based on they are trading at. What business they are doing. Some companies trade at a very high P ratio, some trade at low P ratio, so they come on low. Companies, as far as the law is concerned, you must know that which company are you buying. Okay. Is it what industry is? If the industry is growing at a much faster rate, it will always command a higher valuation. Okay. So I was giving an example, when I was working in Hero Group. So we were trying to sell one of our company to a company outside, and the outside company was called Western Bank. They came and saw our company, and we gave them our valuation based on our intrinsic valuation of Dcf, and the company is worth 500 crores. So they don't believe it. They said, okay, you need to check. So they saw a similar company in Brazil, which was trading at a P multiple of say 50. So they applied that multiple to calculate the value of our company, rather than based on a valuation, which we had given. Okay, and they found the value was just around close to about 800 crore or something like that. Okay, so then this is your real valuation and not 500 crores what you are trying to tell us by giving a DCF technique, because you can always manipulate the DCF technique, saying that you're going to do wonderful business in the next 10 years and generate higher cash flows, and then discounting them using a low, a discounting rate and coming out with a high valuation. Is it all clear to you? Okay, so fine. So this is one thing. Now we just go to another thing, which is called merger and acquisitions. Okay, fine. And some of you, when you're looking at the budget, you can even choose a topic merger and acquisition. You can look at various companies where they have gone for merger and acquisition. What was the purpose? Why they have gone for? And what they have said. I mean, ultimately, resulted in whether they actually. So that can be yet another topic. So we can just say that apart from financial analysis, this can be also one of the topics which you can choose for your project. You can choose either merger and acquisition or financial analysis of the company. Now, why I have done the valuation? Because the merger and acquisition, which I'm going to explain a little bit much now. Okay. So merger and acquisition. Because here, when you want to acquire a company, you must know its valuation, isn't it? That's why you did some valuation, right? So that you have some idea. Okay. Of course, all this requires, almost like a 30 hours lecture to complete this topic. So, but we will be just learning brief, okay, so that we have some idea about that. So, mergers and acquisitions. Is there any difference between mergers and acquisitions? Merger means when two companies come together and form one company, isn't it? Fine. And like we had, any example of merger and recent merger and acquisitions? Idea was from the merger together.
So what about the banks?
All the banks, the banks, yeah. Some 5 or 6 banks within one bank. Okay.
And so an example of acquisition is what Tata acquired Air India.
Tata acquired Air India from, that is the acquisition.
Acquisition,
yes. Yeah. So there is a difference between merger and acquisition. First of all, we must know what is the difference between merger and acquisition. It has, two meanings. They are often, uttered in the same breath. as it means the same. Okay, but merger happens if you look at the real meaning of mergers. Merger when two companies of equal stature they come together and form a new company. Okay, it's a merger. When two companies like A Limited and B Limited, I'll just put, if I can use this here, I'll just equal in basically, in the financial numbers, basically the top line, the bottom line, and number of customers, market share. So whatever parameters you take, of course, you can't find examples of equal nature, but two companies having the same size almost. So suppose, for example, A Limited, okay, and there is another company called B Limited. They come together and they form a new company called C Limited. Okay, so this will be the case of merger. Basically, companies of same size. Of similar size. The right word should be similar size. When they come together, they form a new company. Okay, A and B, they cease to exist, and a new company is incorporated with its own shares. Okay, that means A Limited company shareholders and B will become the shareholders of the combined entity. A and Limited and B Limited will go out of existence. Okay, and C Limited number of shares will get shares of, a new shares will be issued to them in lieu of what they were holding A and B Limited. Is that okay? Now let's talk about acquisition. Okay, acquisitions. Now they can be again, let me put at X Limited here and Y Limited. Okay, they come together. Okay, where one company is strong and another company is weak. Okay, so X Limited acquired. So X is strong and Y is weak. So X may, acquire Y Limited. Fine. X may acquire Y Limited, and the name of the company remains X Limited. Fine. Because X is strong, so it will be able to take away Y Limited. So the Y Limited may be going out of existence, and they will be purchased by X Limited. So one is strong, another is weak. Okay. Fine. Almost like 90% or more than 90% of the deals which happen in the world are acquisitions. There are very rare cases in the world which we can say they are mergers. Of course, Vodafone Idea, people say it's a merger. We can always doubt that, but they are equals. Okay, fine. So they are very pure mergers will be very difficult to find. Okay, so all will be basically acquisitions. Fine. So A Limited and B Limited, when they come together and form a new company, okay, it's called a merger. When A Limited or X Limited acquires the Y Limited, then we say it's an acquisition. So this is the general meaning of merger and acquisition. Okay. But the second meaning is lies in its legal sense. But everyone you must know, there is another meaning which is called so this I say it's a real meaning. Or what should I call it? So I call it real, or then we say legal, in the legal sense. So why that definition is different in legal? Now here, A Limited is another company and B Limited is another company. Okay? They come together. It is nothing to do with the first definition. Now we are talking purely about the legal sense. Okay? A Limited and B Limited, they come together and form either a new company, C Limited, okay, so this will be basically a merger, okay, or they form, the company remains A Limited. This is also a merger, okay. When A Limited and B Limited come together and form a new company, it is called merger by consolidation. So they are consolidating and forming a new company. Okay. A Limited and B company, they come together and form a new company, C Limited. It's a merger. As we have seen in the first definition also, it matches with that. But in the second definition, A Limited and B Limited, they come together. A Limited is a strong company. Okay. They absorb C Limited, and the new company is coming together through the merger route. But it is happening through the merger route. It is called merger by absorption. Here, A Limited has absorbed B Limited. So that means the B Limited shares will be, the company will cease to exist, okay? And all the shares of the B Limited will get the shares of A Limited in certain ratio, okay? And the ratio is called the swap ratio, which we'll discuss later, okay? So based on the market value of that company, the shares will be issued. Like, for example, we'll look at a very little bit older, case, like, and even in the recent cases it's happened, like, ICICI Bank, they acquired Bank of Rajasthan long back, about 10 years back, or maybe a little less than that. Why, ICICI wanted to acquire Rajasthan Bank? Because ICICI wanted to increase their footprint. They were not present in Rajasthan. They had very limited number of branches there, and Rajasthan Bank was the main bank in most of Rajasthan. They had many branches. So either ICICI would have opened new branches there, it would have taken some time for them. So they thought that Bank of Rajasthan is, they can acquire Bank of Rajasthan. They can talk to the board of directors of Bank of Rajasthan, it's a small bank, and give them some price so that it become part of the ICICI Bank. And within no time, ICICI will have its footprint in Rajasthan also. Okay. So for every 10 share of Bank of Rajasthan, 1 share of ICICI was issued to them at that time. Just giving a hypothetical number, it was around that only. So the ICICI Bank remained ICICI Bank. Today there is no Bank of Rajasthan. All the Bank of Rajasthan company, which was a separate company which was listed on the stock exchange, has become part of ICICI Bank. Okay. All the Rajasthan Bank branches, all the full company is now owned by ICICI Bank. I'm coming gradually to that. So let me just complete and then you can answer questions, okay? So either it can be a situation where like Bank of Rajasthan today, we don't find any bank or Bank of Rajasthan because it was there, a few years back. It had its own shares. It was a company itself, so the company was folded, okay? All the shares of the old they were all cancelled and new shares were issued. And now the Bank of Rajasthan shareholders, they have the shares of ICICI Bank. For each 10 share what they're holding, they got 1 share of ICICI Bank. For example, if suppose ICICI Bank was trading at a time of 100,000 and Bank of Rajasthan was trading at 100, okay? So that means 1 share of Bank of ICICI would be equal to 10 shares of Bank of Rajasthan. So this is how we calculate the swap ratio also. I was saying there is a ratio which is called the swap ratio, where the company determines how many shares should be issued to the company which they are acquiring. So one way would be to look at the market value of the shares before merging. Suppose ICICI Bank was having 1,000 rupees per share in the market and Rajasthan Bank was having 100. So that means, so the Bank of Rajasthan will get 1 share for what they're holding earlier, isn't it? So this is also called merger. Okay. But now look at the second one. Is it an acquisition or merger from the first sense? No, legally it is called merger, but actually it was an acquisition by the first definition, isn't it? Okay. Now, when you open the newspapers and read, they say that the merger is happening between Bank of Rajasthan and ICICI. And Bank of Rajasthan will also say that we are getting merged with ICICI. To say that we have been acquired by ICICI, it looks a little bit, not very good sound doesn't good, because always a strong company takes over a weak company. So people always use a legal definition, when it suits them, because they don't want to project that we are weak. Okay. So, but the legal definition says it was a merger, but actually it was an acquisition. Have you got it? Okay. Now, it can also happen that A Limited and there is a B Limited. Okay. Fine. And both the companies exist. A Limited buys, say, 51% shares of B Limited. What happens? A company becomes the holding company and B becomes the subsidiary company. So in that case, this will become the holding company as per Companies Act, and this will become a subsidiary company. Okay. So A will buy B, not by finishing the B. The B will still exist and A will still exist. A is going to acquire 51% shares of B. With the result, A becomes a company which is called the holding company as per the company's definition, and C becomes, because now they control B Limited. Okay. All the board of directors, which are in A, there will be a board of directors in B, which will be controlled by A. The control will shift from B to A. Okay. So they can manage the affairs of A. So this is an acquisition where both the companies may still exist, but one company becomes a subsidiary of another becomes a holding. So legally, it is an acquisition. So this is a legal definition of acquisition. Merger and acquisition in the legal sense and in the real sense. In the legal sense. Now, there is one more word we use more often. This is called amalgamation, which is nothing but merger. It's a word which is used in income tax in Companies Act in India, maybe in some other countries also, which means nothing but which means merger. Okay, because the name can be, a similar name can be used. So in legal sense, an amalgamation is nothing but merger of two companies, which are happening in way of legal sense. So whenever we talk about in income tax, we say that amalgamation has happened. It means that two companies have come together. Okay, fine, and they merged together, not through the holding and subsidiary route. Okay, so merger is equivalent to amalgamation. Is that okay? Fine. So now this is a little bit about merger and acquisitions. And then, what we'll see that, that when the companies are trying to buy another company, they are trying to value another company. Like, case of Bank of Rajasthan was valued by ICICI. What is the value of Bank of Rajasthan? The share price was 100. That was what the relative valuation. But they try to calculate the intrinsic valuation and see whether 100 rupees is the right value or not. Okay, whether it's 90 or 100 or 120. Okay, so both the companies will sit together. They'll try to work out the valuation of the company using all the possible methods which they have and negotiate and arrive at a ratio. And then decide, how many shares will be given for each or how much price per share should be given to acquire that company. Now, if a company wants to acquire 51% stake of another company, how is it able to do it? They can't go and buy from the stock exchange. Okay, it is they can't go to the stock exchange. You can buy 1%, 2%, 3%, 5% shares from the stock market, but if you want to buy more than that and you want to have a controlling stake, okay, then you have to follow a procedure which has been laid down by SEBI. If your intention is to buy the company and get its control, okay, and you want to make it this company as your subsidiary, then you have to follow a law in India which is called the takeover code in India. Okay, in short, it is called the takeover code or takeover law in India. Okay, which we'll talk a little bit, which also the lawyers should know about what is the takeover code. Okay, but after the break. Any questions, please? अभी 10, 14 हुए, सो 10, 30